Millions of people panic buy homes they can barely afford. They stretch their debt to the breaking point. They sign the papers, convinced they are making a smart decision. But here is the uncomfortable truth. For many of you watching this, your house is not an asset. It is a liability dressed up in a white picket fence.
When you rent, your money is gone. Everyone agrees on that. But when you buy, people say your payment is savings. This is false. In the first years of a 30-year mortgage, nearly 80% of your payment goes straight to the bank as interest. You are not paying yourself. You are renting money from the bank. Then there are property taxes, a forever rent you pay to the government. Then maintenance costs, 1 to 2% of your home value every year. Then insurance, then buying and selling fees that eat up to 10% of your home value. Add all of this up, and the true cost of owning is often higher than renting.
There is one number that tells you whether to buy or rent in your city. It is called the price-to-rent ratio. Take the price of a home, divide it by the annual rent of a similar home. If a house costs $500,000 and rents for $2,000 a month, that is $24,000 a year. Divide $500,000 by $24,000. You get a ratio of 20. Below 15 means buy. Above 20 means rent. In cities like New York, San Francisco, Toronto, and Sydney, ratios are hitting 25, 30, even higher. The math is screaming at you to rent. Here is the wealth killer nobody talks about, the down payment trap. To buy a $500,000 home, you need $100,000 down. That money is now locked inside a wall. It produces zero cash flow. It is trapped. Now, imagine you took that same $100,000 and invested it in the stock market. Historically, the S&P 500 returns 10% per year. That money doubles every 7 years. 100,000 becomes 200,000, then 400,000, then 800,000. By locking your money in a house, you are betting that your single local real estate market will beat the entire global stock market. And historically, real estate loses that bet. Nobel Prize winner Robert Shiller proved that over the last century, real home prices barely outpaced inflation. Here is the strategy that changes everything. Rent and invest the difference. Compare your rent to what ownership would cost, including all hidden costs. Take that difference every month and invest it into index funds. Do this for 20 years, and you will likely have a higher net worth than your homeowner neighbor. The renter stays liquid, free to move for better jobs, free to rebalance investments, free from maintenance stress. The homeowner is house rich and cash poor, trapped in an illiquid asset they cannot eat, cannot invest, and cannot sell quickly without massive fees. Which one sounds like real wealth to you? Your house is an anchor. If you get a job offer in another city paying $50,000 more, the renter packs up and leaves in 30 days. The homeowner is trapped. They must sell the house, pay 6% in agent fees, pay closing costs, and potentially sell at a loss if the market is down. The exit cost can wipe out years of equity in one afternoon. Renting buys you optionality, and in a fast-changing world, optionality is priceless. I know what you're thinking, but rent goes up every year. My mortgage is fixed. This is true. A fixed mortgage is a real advantage. But while your mortgage payment is fixed, property taxes go up, insurance premiums go up, maintenance costs go up. You are not protected from inflation. You are just exposed to it differently. And here is the key point. While rent goes up 3% per year, your investment portfolio grows 7 to 10% per year. The gap between your investment returns and your rent increase is exactly where the renter wins. I am not saying never buy a house. Buying makes sense in specific situations. Number one, if you are staying in the same city for 10 or more years. Number two, if the price to rent ratio in your area is below 15. Number three, if you value stability more than flexibility. But do not buy because you feel shame for renting. Do not buy because someone told you rent is throwing money away. A house is a place to live, not a guaranteed retirement plan. Run the numbers first. Always run the numbers. The path to wealth is not about owning a deed. It is about owning income-producing assets. Stocks, bonds, businesses. These are assets that pay you. A house is an asset that you pay. Do not let cultural pressure bully you into a bad investment. Check the price-to-rent ratio. Calculate the unrecoverable costs. And if the math says rent, then rent with pride. Invest the difference. Build your liquid empire. And let the landlord worry about the roof. If this video changed how you think about wealth, hit like and subscribe to Theo Invest. New videos every week that the financial industry hopes you never watch.